Question 2. The first reason is increase in foreign demand for Malaysian goods and service. Foreigners who want to buy Malaysian export need RM to pay Malaysian producer, so they buy more RM and sells less RM in the foreign market. This will decrease the supply of RM, therefore RM will appreciate. The Malaysian consumer and importer will benefit because imported goods become relatively more cheaper. The second reason is more attractive investment opportunity in Malaysia. Higher interest rate, stronger economic growth, or better return attract foreign investors. So foreign investors must obtain RM to invest in Malaysia. The supply of RM decrease as demand for RM increase. Therefore, RM will appreciate. The Malaysian firm and the government will benefit because they can attract more foreign capital. And consumers also get benefit from a stronger ringgit. Third reason is speculation. Investors expect the ringgit value to increase. They buy and hold RM now to profit later. Therefore, fewer RM are suppressed in the foreign market, so RM will appreciate. Who will benefit, which is current trader and investor holding RM, and Malaysian consumer and importer benefit from stronger purchasing power abroad. The question 2b given the price in Malaysia is 15 ringgit and the price in US is USD 5 ringgit and 50 cents, and the market rate is RM 4.20 per USD. Now we calculate the implied PPP, which is domestic price divided by foreign price, then which is 15 ringgit divided by USD 5 ringgit 50 cents. So we get the answer 2 ringgit 73 cents per USD. Next we calculate the variation, which is implied PPP minus actual rate divided by actual rate and times by 100. Then we get the answer negative 35%. This means that RM is undervalued by 35%. Question 2c given price in Malaysia is RM 5,500 and price in US is USD 102,050. Malaysian inflation is 2.5% and US inflation is 3.8%. Spot rate is RM 4.40 per USD. Now we calculate the implied PPP exchange rate, which is the domestic price divided by the foreign price. Then we get the answer RM 4.40 per USD. Then we calculate the relative PPP, which is the inflation domestic minus the inflation foreign, which is 2.5% minus 3.8%. Then we get negative 1.3%. Then we calculate the expected rate, which is 4.40 times by 1 minus 0.013 squared. We get the answer RM 4.29 per USD. Since the actual rate RM 4.30 per USD is more than the PPP expected rate, which is RM 4.29 per USD, it means it takes more RM to buy 1 USD than issue. The RM is undervalued against the USD. Long position in a currency means that the party has the right or obligation to buy the currency in the future. The important of firm with future foreign currency payable typically take the position, and the FX risk being hedged is receipt risk. If the currency appreciates, the value of foreign receipt will fail. For example, a Malaysian importer such as UMW Toyota Motor importing vehicle from Japan may buy the JP yuan forward to lock in the cost of future payment. The short position in the currency means that the party has the obligation to sell that currency in the future. The exporter of firm with future foreign currency receivable typically take the positions. Then the risk is payment risk. If the domestic currency depreciates, the cost of buying the foreign currency will rise. For example, a Malaysian exporter such as Togolf Corporation exporting golf to the US may sell USD forward to lock in the RM value of future export receipts. Question 3b given the spot rate is RM 4.15 per USD and the 3-month forward rate is RM 4.09 per USD. First, we need to determine which is forward premium or forward discounts. Since the forward rate is smaller than the spot rate, the USD is expected to be worth less RM in the future. Therefore, the USD is typically at a forward discount. Second, we calculate it. The formula is the forward rate minus the spot rate divided by spot rate times by 12 per month, then times by 100. Then we get the answer is negative 5.783. This means that USD is trending at an annualized forward discount of 5.78%. Question 3c is given that the side W will receive the USD 120,000 from an European buyer in 3 months. The spot rate is RM 4.15 per USD and the forward rate is 4.09 per USD. Then the actual spot rate in the 3 months is RM 4.25 per USD. ZW should take a short position to hedge against the risk that the USD may depreciate against the RM. By selling USD forward, ZW fixed the exchange rate at 4.09 USD and eliminate the exchange rate uncertainty. Next, we calculate the RM revenue under the forward contract, which is USD 120,000 times by 4.09. Then we get the answer is 490,800. Then we also calculate the RM revenue at actual spot rate, which is USD 120,000 times by 4.25. So we get the answer is 51,100,000. Next, we need to determine which is gain or loss. So we calculate the difference between them. Then we get the answer is negative RM 192,000. This means the hedging resulted in the loss of 192,000 ringgit compared with the actual spot outcome. If ZW remained unhedged, it would have benefited from the stronger USD in receive more RM. However, the purpose of hedging is not to maximize profit, but to reduce exchange rate risk and provide certainty. Section 6A is about the limitation of the traditional approach. The first limitation is focus on trade flow only. The traditional approach focuses on export and import only while neglecting financial assets and interest rate differential. For example, when the US Federal Reserve maintains relatively high interest rate, many investors prefer holding US dollar assets because of high return. This strengthens the USD against the RM despite Malaysia continue to record positive export earnings. The exchange rate was therefore influenced by financial return rather than trade alone. The second limitation is inbound capital flow. The traditional approach assumes that exchange rates are determined mainly by trade in goods and services. However, in reality, international capital movement can be much larger than the trade flow. For example, during 2024 and 2025, the Malaysian ringgit RM was influenced significantly by foreign portfolio investment entering and leaving the Malaysian bond and stock market. Even when Malaysia's trade performance remained relatively strong, capital inflow and outflow affected the RM values. Therefore, good trade factor alone could not fully explain exchange rate movement. Third is neglect the rule of money supply and monetary policy. The traditional approach does not consider how change in money supply and central bank policy affect exchange rate. For example, the monetary policy decision of Bank Negara Malaysia and the US Federal Reserve affected investor expectation and currency demand. Change in interest rate and liquidity condition influence capital flow and the value of the RM, showing that monetary factors were important determinant of exchange rate. The last limitation is inbound expectation and portfolio decision of investor. The traditional approach assumes exchange rate adjusts mainly through trade transaction and overlook investor expectation about future economic conditions. For example, investor expectation regarding future US interest rate, Malaysian economic growth, and global economic conditions influence their decision to hold RM denominator or USD denominator assets. Such portfolio adjustment affected the RM value even without any immediate change in Malaysian export or import. This demonstrates that expectation and asset preference play a significant role in determining exchange rate. Question 6b, given the GDP growth is 5.5% and OPR is 3%, US Fed is the 4.5%. According to the monetary approach, strong economic growth increased income and transaction activity in the economy. As Malaysia GDP grown by 5.5%, households and firms require more money for spending and investment purpose. Therefore, money demand increased. Assuming the money supply remains unchanged, while Bank Negara Malaysia keep the OPR at 3%. The increase in money demand creates an excess demand for money. To obtain money, people reduce spending on import and financial assets, causing funds to flow into the country. This leads to a BOP surplus. Therefore, demand for Malaysian ringgit increased and appreciated. The portfolio approach views exchange rate as being determined by investor allocation of wealth among domestic and foreign assets. Malaysia's strong GDP growth of 5.5% signals a healthy and expanding economy. Foreign investors may expect higher corporate profit, better stock market performance, and improved investment opportunity in Malaysia. As a result, investors rebalance their portfolio by increasing their holding of Malaysian stock and bond. To purchase this asset, they must buy Malaysian ringgit. Demand for Malaysian ringgit will increase and later will appreciate. Yes, both of these approach predict an appreciation of the Malaysian ringgit. The monetary approach, which GDP growth increase money demand and creating a BOP surplus, then effect to Malaysian ringgit is appreciated. Second is portfolio approach. This strong growth attract foreign investment and capital inflow, then also lead to the appreciation in MIL. Although the higher US interest rate, which is 4.5%, may encourage some investors to hold USD assets, Malaysia's strong economic growth provides a positive signal that attract investment. Therefore, both approaches generally predict greater demand for MIL and an appreciation of the ringgit. For part Malaysian bond, foreign investors sell or reduce holding because Malaysian market assets are seen as riskier. Demand for Malaysian bond fell, bond price drop and yield rise. While in the part of MIL deposit, foreign investors withdraw or avoid holding Malaysian ringgit deposit because they prefer stable USD-based assets with higher stability and liquidity. And the capital will flow out of Malaysia and funds move towards safe haven assets such as USD. This leads to less demand for Malaysian ringgit, then lead the Malaysian ringgit depreciate, USD becomes stronger relative to Malaysian ringgit. Malaysian ringgit weaken. How can BM do is BM can increase or maintain OPL at a relative attractive level. It is because higher OPL will increase domestic interest rate, make Malaysian assets more attractive to foreign investors. This can encourage capital inflow or reduce outflow and support Malaysian ringgit by increasing demand for Malaysian ringgit assets. Portfolio approach support this action because investors can allocate well based on risk and return of assets, not just interest parity. Higher interest rate increase the relative attractiveness of Malaysian ringgit assets, so capital flow respond to portfolio reallocation decision. For monetary approach, capital flow adjusts to restore equilibrium in money market. Higher interest rate reduce outflow and support currency. For portfolio approach, this higher interest rate improve return on Malaysian ringgit assets. Investor rebalance portfolio toward Malaysia assets. Both make same decision, which is higher OPL lead to capital inflow and Malaysian ringgit appreciate or stabilize. The first type is transaction exposure, means the risk that the cost of a transaction changes due to the exchange rate fluctuation between the agreement date and the settlement date. For example, Saitapi plantation export palm oil to India and will receive USD 5 million in 3 months. If the USD weakens against the RM before payment is received, the company will get less RM when converting the USD revenue, causing a loss. Second is the translation exposure, means the risk that the value of foreign currency denominated assets or liability change when consolidated into a parent company's financial statement due to exchange rate movement. For example, Petronas Malaysia has subsidized in Europe. If the euro depreciates against the Malaysian ringgit, the euro denominated assets translate to fewer MIL in the balance sheet, reducing reported equity. Third is economic exposure, means the long-term risk that exchange rate change affect a firm's future cash flow, competitiveness, and market value. For example, top growth Malaysia, a rubber exporter, face competition from Thailand. If the Malaysian ringgit appreciates against the USD, Malaysian rubber become more expensive globally, reducing demand and for future revenue. Question 8B, given the spot rate is RM 4.50 per USD and the forward rate is RM 4.44 per USD. Now we need to determine which is forward premium or forward discount. The formula is forward rate minus spot rate divided by spot rate and times by 12 divide months times 100. Then we get the answer is negative 5.23%. This means the USD traded at a 5.23% annual discount against the RM in the forward market. Market expect RM will stronger and weaken USD in the future. At C, given that Malaysia will receive USD 600,000 and spot rate is RM 4.30 per USD, forward rate is RM 4.22 per USD, and actual spot rate is 4.10 per USD. First, we calculate the RM revenue under the forward contract, which is USD 600,000 times by RM 4.22. Then we get the answer 2532,000. Next, we calculate the RM revenue under the actual spot rate, which is USD 600,000 times by RM 4.10. Then we get the answer RM 2460,000. Third, we calculate the gain from hedging, which is the difference between the RM revenue under forward rate and the RM revenue under the spot rate. We get the answer is RM 72,000. This means the exporter gained 72,000 RM by hedging. The hedging decision was justified because it protected the exporter from the appreciation of the ringgit and resulted in RM 72,000 more revenue than if no hedge has been used. Question 9a, given that Malaysia interest rate is 5% and US interest rate is 3%. Spot rate is RM 4.50 per USD and forward rate is RM 4.41 per USD. Now we determine if CPI hold or not. We use the formula that 1 plus domestic interest rate equal to 1 plus foreign interest rate times by foreign rate divided by spot rate. Then we get the answer 1.05 not equal to 1.01. So it means that CPI does not hold because it's no sense. Now we assume the investor have 100 ringgit to invest in 1 year. If investor invests in Malaysia, which is 100 ringgit times 1.05, then investor will get out at 105. If we convert to USD, which is 100 divided by 4.50, we get the USD 22.222. Then we invest at US, which is times by 1.03. Then we get the USD 22.889. Then we convert back into the MYL. We get the answer is 194. Question 9b, given that Malaysia interest rate is 5%, US interest rate is 3%, and spot rate is 4.50 per USD. First, we calculate the expected rate, which is expected rate minus the spot rate divided by spot rate, equal to domestic interest rate minus the foreign interest rate, which is expected rate minus the 4.50 divided by 4.50, equal to 0.05 minus 0.03. Then we get the expected rate is 4.59. Then we calculate the expected RM return in Malaysia, which is 100,000 times 1 plus 0.05. We get the answer is 105,000. Next, we calculate the expected RM return in US, which is 100,000 divided by 4.50. We get the answer 22,222.22 USD. Then we use this figure times by 1 plus 0.03. We get the answer is 22,888.89 USD. Then we convert back to the MYL. Get the answer is 105,060. The returns are almost equal. CPI hold because investors receive approximately the same expected return in both countries after adjusting for expected exchange rate changes. Any small difference would be eliminated by aggregate in efficient market. When foreign investors increase investment in Malaysia, this helps Malaysia credit lending improve and GDP growth exceeds expectation. Foreign investors increase investment in Malaysia lead to demand for RM rise. RM appreciate in the foreign exchange market. Capital inflow increase the surplus of loanable fund. Loanable fund surplus curve shape like. Then Malaysia equilibrium interest rate fall. Lower interest rate stimulated domestic investment and economic activity. Question 10a, given that Malaysian nominal interest rate is 5% and their expected inflation is 1.5%, and UK nominal interest rate is 4%, expected inflation is 2.5%. We calculate the real interest rate, which is nominal interest rate minus the expected inflation. For Malaysia is 5% minus the 1.5%. Then we get the answer is 3.5%. For the UK, real interest rate is 4% minus the 3.5%. The answer is 1.5%. Capital will flow from the UK to Malaysia because real interest rate in Malaysia more than the real interest rate in the UK. Their nominal interest rate will eventually converge and become equal as capital flow from the UK to Malaysia. The price for loan-able fund Malaysia will increase, which puts downward pressure on Malaysian nominal interest rate. The capital outflow from the UK reduced its surplus of loan-able fund, putting outward pressure on the UK nominal interest rate. This arbitrary process continued until the nominal interest rate in both countries reached an equilibrium. The J-curve effect explains how a country's trade balance reacts after its currency depreciates. The first one is impact, with the time period is immediately, normally is 0 until 3 months. The import bill rise in area instantly and the export volume unchanged pre-committed order, no benefit yet. This will causing the trade balance worsen. The first one is recognition, with the short run normally is 3 until 6 months. In this process, buyers start noticing price trend, import volume beginning to decline slightly as consumers and firms reduce purchase of foreign goods, and export orders slowly increase since Malaysia export become cheaper for foreign buyers. This was stabilized but still below pre-depreciation level. Third phase is adjustments, with the median run normally is 6 until 18 months. In this process, import volume fall as substitute found. The export volume rise as foreign buyers shift to Malaysia. The trade balance being improvement because higher export and lower import. 4 is a new equilibrium, with the long run normally is 18 and out month. In this process, import demand adjusts fully, resulting in lower import volume despite higher price. Exporters benefit from increased competitiveness, leading to sustained growth in export volume and export earnings. In trade balance, it significantly improved and may move into a larger surplus than before the depreciation. Malaysia experienced a relatively weak outcome during 2023 to 2025. In the short run, higher import costs increase the value of import, putting pressure on the trade balance. However, over time, Malaysia export, particularly electronic, palm oil, and manufacturing products, become more price competitive internationally. As export demand recover and import growth moderate, the trade balance improve, illustrating the long-run outward portion of the J-curve effect. Question 10C, given that Malaysia depreciates 10% and elasticity for export is 0.4, for import is 0.3. First, we determine is the Marshall-Lerner condition satisfied, with the formula is elasticity demand for export plus elasticity demand for import will more than 1, which is 0.4 plus 0.3 will more than 1, but is only 0.7, it is smaller than 1. So the Marshall-Lerner condition is not satisfied. Second, we calculate the change in export volume, which is the elasticity demand for export times by percentage of depreciation, which is 0.4 times 10%. We get the answer is 4%. We also calculate the change in import volume, which is elasticity for import times by percentage of depreciation, which is 0.3 times 10%. We get the answer is 3%. This trade balance will be worsened, although export volume increased by 4%, while import volume decreased by 3%. The response of quantity is too small because both demand elasticity are inelastic.